Hi, everybody. This is Jason here with the Money, Success, and Happiness channel. Have you ever wanted to start investing, but you were scared because you didn't know what to do and you didn't want to lose your hard-earned money? I understand, and I'm here to help. So, a lot of us don't start investing because we're scared to lose our money, and we don't know enough. And if none of our friends or our family invest, it's very hard to start to take that first leap into investing. Now, right now, it's a great time to start investing because right now, a lot of stocks are actually a lot cheaper than they used to be because of the situation we're going through. So, if you want to start investing, I'm going to tell you how to start simply and easily, and just invest a little to kind of get your feet wet and start kind of figuring out how everything works. So, first of all, you're going to need a brokerage account. Okay, so today what we're going to be looking at is we're going to be looking at Robinhood, because Robinhood is my favorite investing brokerage because it's just very simple, very easy to use, and it's very user friendly, and the interface is very simple. So let's go to Robinhood. Okay. Now we're in the Robinhood account. So, as you can see, I have almost $17,000 invested right now. Okay? But you obviously don't need that much to start investing. I would recommend starting anywhere from $500 to $1,000 to start your first investment. Okay. So, let's go to investing. Okay, as you can see, I did fairly well today. I made almost $500, and the after hours, it's up almost $70. So these are all my stocks. I can go over these more in detail at a later time. But first you need to know that there is two types of investing, okay? There's fundamental and analytical trading, okay, and investing. And fundamental is basically you have a company and you think that company's doing well, you think it's been doing well in the past, and you think it's going to do well in the future. So you're buying that company because you want to hold it for a while until it increases in value. Now, analytical trading is basically day trading. Okay, so what they do is they'll take data, basically indicators and stuff like that on a screen, and what they'll do is they'll actually think, okay, this is going to go up or down, and they really don't care about the company much. All they care about is if it's going to go up and down in the short term. So they're looking more at like either a couple minutes, a couple days, a couple hours, stuff like that. So that's a lot riskier. I don't recommend you do that as a beginner. If you do that, there is some sites where you can paper trade with like fake money so you can get a hang of it, but it's not as easy as people think it is, and you're going to see a lot of videos online saying like, oh yeah, buy my course and you can be a day trader overnight and just do what I don't believe it, okay? Because if they were so rich, then they wouldn't have to go on there trying to sell courses to people, okay? So just remember, all the billionaires in the world are basically long-term fundamental traders, okay? Look at the richest people in the world. Those guys all invest for the long term, not the short term. So just an idea. Anyways, so let's talk about in the Robinhood account. There's basically, I'm going to just give you the three basic vehicles to start investing. You got stocks, which is owning a part of a company. You got bonds, which is basically you're giving out a loan to either a corporation or a treasury or something. So you're saying, okay, I'll give you out a loan for this long of time, and then you're going to pay me an interest rate back at the end of the bond, okay? And also, like, then you can also invest in like commodities like gold. That's another one. So let's just talk about those three today. Those are like some of the most important ones. So basically, a stock, let me just give you an example. Let's go down a little bit. You can see stocks, boom. Okay, take Microsoft for example. Okay, look, it's trading at $188, and this is its performance. You see the day, the week, the month. Okay, real easy. That's my position, and it means how much I have of it. So I have 20 shares right now. Average price. Equity is how much you have invested total. The percentage of my portfolio. Today's return and my total return on it since I bought it again. And then you got the statistics. That's the opening price and the high, the low, the 52-week, the 52-week high, the 52-week low. Basically, you just see how it performed over the last year. The volume, that means how many people traded it today. The average volume, the market cap is all the shares and all the investors total together. So it's got a $1.43 trillion market cap, okay? Biggest company in the world, guys. Okay, I'm starting you guys with the top, okay? That is massive, okay? This company is extremely large, and I would love to be Bill Gates. So, anyways, the profit to earning ratio means that basically you want it a lower PE ratio. I don't want to confuse anybody too much with that, but that basically means the higher the PE ratio means that they're making less money for every dollar you're investing. But a lot of tech companies and companies that are growing really fast have a higher PE, so that's why that explains that. And then the dividend ratio is 1.09, which means that they're going to pay you a dividend yield of basically 1% of all the money that you have invested. That you're going to get that paid out to you every year, but they pay it out in usually they pay it out in quarters. You're going to get that back. So let's say if you have $1,000 invested, well, you're going to get that 1% of $1,000 on top of how much that stock grows every year. So that's all that means. And you got the news, you got what people are doing, the analysts, most people are buying, and some people are holding. You got, I'm a gold member, so you got this is the Morningstar report saying it's 3 stars and its moat is wide, which means it doesn't have a lot of competition. The fair value, which the prices should be around, which this is higher, so that means this is good value right now. Uncertainty, like what's going to happen in the future, and stewardship, how they handle your money. Okay, so they're handling your money well. This is the earnings, what it made every quarter. This is what people also bought. Okay, so this is showing what people that have this stock, what they bought. This is margin, which is basically taking a loan out from your brokerage. You can usually borrow about ×2. So if you have 1,000, you can usually borrow 2,000. I'm just giving an example. And so you can leverage your money and make more. The dividend, your price, your history of buying and selling, what it's featured in, and the CEO, and a little bit about the company. So that shows you what a stock is. Okay, now let's go to a bond. A very popular bond, let's say, is all the bonds are in ETFs. So let's see. Let's go to this one. Okay, so this is a real popular bond, and it's not like you can just buy one bond. The bonds are all in ETFs, which are basically like a mutual fund, all pulled together. So it's a bunch of bonds. It's not just one bond. This is like a bunch of bonds, but they're all 20+ year treasury bonds, which are a real safe vehicle. Usually stocks fluctuate more, but stocks make more money. Bonds are a little bit safer. They don't fluctuate as much, but they don't return as much either. So they say the older you are to put more money in bonds. That's up to you. I like stocks myself. I'm more of a stock guy because they make more money. They're a little more volatile, but they make more money overall. So what it is a bond. So all these people are getting pulled together and they're loaning out money to the treasury. That's 20+ years, and the treasury is saying, okay, thank you for the money. We're going to pay you back a percentage. And right now it's 1.841, which really isn't that high. And usually stocks and bonds kind of move opposite. So if stocks are going up, bonds are usually going down, vice versa. Sometimes they both go up. Like today it went up. So sometimes they both go up together, but I'd say the majority of the time Usually, like if the market's crashing, bonds are going up because people pile their money into bonds because they, it's like a sinking ship, so they feel they're safer if they put their money into bonds. Okay. And let's see, same thing, shows you what it is. And there's all kinds of different kinds of bonds too. There's corporate bonds, there's treasury bonds. So not all bonds are that safe. Treasury bonds are this safe, but like corporate bonds is pretty much the same as like a stock, because if they're gonna basically look at the company. Okay, so they're not just gonna, like, treasury bonds are safe because they say, okay, the government is backing it, but a corporate bond from a big corporation, especially if they're like junk bonds, which means they have a lower rating. Those aren't safe. Those aren't like stuff that people run to in times of security. But a treasury bond like this one, or the different treasury bonds, this one's from iShares. There's like these big companies that they have they make different ETFs for people to invest in, and what they do is they charge a very low like a rate. They charge very small rates of your money. So like if you buy this treasury bond, it might cost you 0.05%. I think this one is like 0.15%, I'm pretty sure. But anyways, you can look that up on Yahoo Finance and some other sites. We can look that up later, but I'm just going to show you the basics. Like basically you're paying a really tiny small percentage of your money that you earn to the iShares company to actually pay them back for creating this ETF for you. Okay, so now lastly, I'm going to show you like gold. So this is the biggest gold trust there is. It's GLD is the ticker symbol, and this one, as you can see, it has 61.60 billion people invested into this. So it's really huge, and it is okay. Gold tracks the gold spot price, less expensive, and liabilities using gold bars held in London. Okay, so this is actually backed by physical gold, which is commodity. So those are basically some of the vehicles. Now I showed you an individual stock. What I'm gonna do is, now gold, let me tell you a little bit about gold first. Is what gold is like, it goes up and down. It's more of like one of those safety things, like the treasury bonds. I told you, like a lot of times when the market's bad, people will pile into gold to think it's safer, but gold is kind of fluctuates a lot. It can be up, it can be down. There's a lot of factors that are linked to gold, but a lot of people from the beginning of time, people love gold, and they think, when they think the dollar isn't gonna be worth much, or like right now how the Fed's pumped in a bunch of money. A lot of people are like, well, I better go to gold because gold will protect me. So some people believe that commodities like gold is a better place to put your money than like stocks and stuff. So it just depends on who you are, or you can mix them all together if you want to make a real safe portfolio. You can go to a little bit of gold, a little bit of bonds, a little bit of stocks. People do that too. So, but if you're just starting, I'm going to show you a vehicle that's probably like the best for you to start, is putting your money in something that is an index fund, which is one of the basically safest ones is VOO or VTI. They're almost the same thing. They're both from Vanguard. Let's go to VTI. Okay. So this thing together is holding like several thousand stocks. Okay, and it's following an index that is basically all US companies. So this is like, and they're all like arranged by market cap. So the bigger ones hold more weight than the smaller ones. So something like this, if you have like $1,000 to start investing, you can put your money into like VTI, and basically it's tracking all the biggest companies, the top 500 companies. Okay, it's called the S&P 500. It's an index. Basically, it's an index that shows you like what the economy is doing. If you ever seen on the news, they say, oh, the S&P 500, the NASDAQ, the Dow, all those are is like companies grouped together that are kind of showing you like what the climate is of what's going on right now. So when you're looking at the S&P 500, that's like basically our whole economy. Like, how's our economy doing? Okay, so right now everything's opening again, and because you had the corona and everything, so everything's starting up again. So the S&P 500 is going up right now. You know, there was a lot of jobs lost, but now the jobs are coming up and things are opening, and people are pretty optimistic right now. So a lot of people are buying into the S&P 500 right now, which is the top 500 companies. Okay, and I'll show you later how you can actually see what the holdings are in these vehicles. But and it's like I said before, it's a very low. The expense ratio for this one is like 0.03. So it's like almost non-existent. You're never going to notice that they're taking a 0.03. They're making money because they have a lot of people invested in these ETFs. Okay, so as you can see, there's 150 billion people invested in this company. But yeah, let me show you, like, over the last 5 years. Look at this thing. This thing has gone up. Before the corona, it was like 60% return. Okay, on 5 years. So that's over 10% a year. Okay, this is a very safe vehicle. There's other indexes, there's other ETFs that follow different indexes, but to start, this is a really good one to start. If you did want to mix it up, like I said, you could always maybe do 50-60% of VTI, and then you could do some treasury bonds like we showed you. You could do a little bit of treasury bonds, and then you can mix in a little bit of gold. Okay, that's actually a strategy I'm going to get more into later. But if you have all three of those, your money, you're not going to see big fluctuations because they kind of move opposite of each other, and overall you're still going to be making around 10% a year. So I hope that helped everybody a little bit how to invest your first $1,000 in the stock market, or $500 or whatever you can spare, and just try it out. Maybe put it into VTI and see what happens. You know, and you probably like it, and you'll probably get addicted to it like I did, and you'll invest more in the future. So I hope this helped everybody. And also in my on my about page, I have links to Robinhood. So if you guys want to click on that link, you'll actually get a free stock, and it'll get you started. So it doesn't take long. It takes like 5 minutes, and you can just get a free stock just to see how it works, and then you guys can get used to it. So if you want to, it'll help me out too. It gives me a stock and you a stock, so you can on my about page just click the link and sign up for Robinhood. And if you have any questions, just let me know. You know, I'm here to help. I got my website on there, so if you need anything, just let me know and I'll help you out. All right, thanks.